Live. Okay, sweet. Okay, so I didn't know people actually watch my VODs, but apparently they do. I'm just gonna let you know now because you probably know ahead of the people on Sunday. I screwed up one of my hard drives, and by one I mean probably both of them. One's kind of okay, the other one's kind of like dying on its way out. So until I get those new hard drives, I might or might not have the weekend video. I might just go live instead. So surprise there. There wasn't a lot to research this week. Like a lot's happening, but again, the problem with my stuff is that I see things so far in the future that people call me crazy. People say it's not possible, and that's just something I have to deal with. But yeah, so right now the biggest issue I have is that everybody's running on hopium right now for the market because it just kind of dipped, but it finally caught a bid. We're kind of climbing a little bit back up right now. The insiders, there's not a lot of insiders going on right now. The weekend stuff that I'm doing is actually kind of interesting, and if you guys want to check this out, I have a subscribe start down below. I'm still in the middle of setting it up, but if you become part of my subscribe star and you subscribe to the second tier, I'll give you access to some of my notes and stuff like that, and I'll give a little bit more color on the situations and how I play them. They're not an indication of how to buy or sell anything like that. You guys can figure that out yourselves. This is just data tracking for me. Again, you come to your own conclusions in that scenario. But for the insider bias, the only ones I've been seeing is this one guy that just keeps exercising his options, which doesn't really enthrall me a lot, but it's actually kind of interesting because this person hasn't sold it. Typically, when a CEO exercises their options, they kind of just sell it immediately. But again, it's not in the sector. It's not a very talked about stock, and unfortunately, right now, and I just don't want to lead into it because it's just not very appealing to me in general right now. Some of the other strategies, other than the insider stuff that I'm doing, is you'll get access to the weekend stuff as well as some of the seasonal stuff, which is kind of on pause right now because I'm kind of afraid of what's going on in the market. Again, I don't know what's going to happen, but if I was to throw out a theory right now, my theory is that everybody's going to be so fixated on a Christmas rally, they're going to take any sort of small modicum of a rally and pretend it's like, oh, it's so great and everything, right? Again, I'm not 100% sure. That's just my theory right now, but there's not, like I said, there's not a lot of research right now. I was actually thinking of digging up one of my old strategies right now, which is this was called the DK indicator, otherwise known as the Dunning-Kruger indicator. And if you guys know anything about Dunning-Kruger, it's more so that, again, I'm giving it to you very blunt here because like I was never babied in this sort of sense, but you have to find someone that's so terrible at trading that everything that they touch literally turns to dust. Like they're a 90% loser, they're your 90% winner. A lot of people have said that about me, but not a lot of them are still around anymore. So who's the real Dunning-Kruger here, right? But the concept of this was developed because I noticed a lot of people who were not trading, who've never touched the market, before the whole retail push and everything, was that a lot of them were getting into the market and acting as if they knew something, but they didn't. They missed very critical concepts, like, for example, what's that, Pike? Yeah, they miss a lot of critical concepts, such as when they talk about the DTCC, and there are other clearing corps like the NSCC and say that, oh, this is the MOAS of stuff like that. They miss a very, very critical concept to that, which is if they were to, if this was the actual MOAS, they wouldn't be able to know. They can't tell. They went from like saying, oh, 60% short squeeze on AMC to like 20% saying that's a MOAS. Going from 60 to 20 does not make it even not make it bigger. That actually reduces it. And if you actually looked at the 13Fs subsequently going back, they were buying it up at $8. So none of that makes sense. So you would again, you would reasonably say, as someone who's detached from the situation, okay, well, they're letting them spin this narrative that there's a 60% shortage, just which there wasn't. But people are willing to throw their money at this, and okay, well, we're not going to stop them because it's a free market. They can throw their money if they want to, right? And they did, and they moved it up to about $50, $60, but then it's back down to 40 now, and they're still going with this narrative that like, oh, we should keep pushing this, we should keep pushing this. You can only keep doing something in the stock market if you have money. And a lot of people right now that we're into October are running out of money to keep this up. So right now the narrative is obviously, Citadel's bad, AMC to the moon and all that sort of stuff, but honestly I don't see it. Because let's do some background research here. Let's look at one of the foremost appointed experts on the situation. Again, you can add him to your DK indicator. Like I probably would, but he doesn't expansively focus in other areas. I want someone that's jumping constantly. If he just keeps focusing on one stock, it's kind of hard for me to play off of that because they're leading to every little bit of information. It's too much noise. Again, I'm not saying that it's totally disregarded. It's just there's some more research required and observations. But 20% short interest utilization just means the amount of shares that are reported to be utilized short through every agent. So if I have, like, for example, 200 million shares, and 60 million of those shares are available for shorting, 80% of that would be what? Let's see, 60 divided by 0.8. Oops. Divided by 0.8. Oops. No, wait. I did that wrong. Hold on. There we go. So about 48 million of those shares are currently shorted at the moment, and which leaves 12 million not utilized and so forth. But honestly, it's 60 million of 200 million. That's still not saying much. Like, what about the other 140 million? If they offer a good enough rate, then more shorts could come on the market. It's always a tug of war game of like who has more money, right? Or in an institutional case, if against the retail, who's willing to do more price discovery? And I can guarantee you, these guys have a lot more money to do price discovery than you guys do to have to keep pushing this up. But again, I digress. So I should probably post this on Twitter and actually promote myself a little bit because I don't do that enough. And I can't find the URL. Okay, I'll do that later. Whatever. I'll just need to note that down for future. But okay, so yeah. Again, not a useful gauge of anything. But let's just scroll through and see what they have to say. Hearing rumors that dark pool trading was, again, when they say dark pool, I don't think they know what they're talking about, because a lot of people didn't even know what dark pool is. Let's go look at this guy's previous history. What did he do before this? AMC, 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 AMC. Okay. Nothing. Nothing. It's just memes. Honestly, that's all it is. It's just memes. And this is one of the biggest problems I have with people. It's just, I'm not just saying that just this guy. There's like a whole bunch here, but the biggest problem I have with people like this is that, especially like with someone that is like constantly on this like whole kick of like, oh, they're just the MOAS is near and stuff like that. They're playing you. They're utterly playing you, because they, like, if the MOAS is here, they've been saying the MOAS is here for like months on end. Like, it's almost been a year now that they've been saying the MOAS is here. There was a squeeze that happened between $40 and $50, and that's what you saw with the first push up. Because what happened was that market makers have to keep an inventory of both sides, because their job is to provide a fair market and give the least. Essentially, they have to keep the spread as little as possible. And when they step away, you saw that back in earlier in the year when we jumped from 40 to 50, and that's when I started screaming. I was like, I think a market maker went down, because they had to take the other side of your trades. They had to fulfill those orders and collect that inventory. And when we started circuit breaking up, that kind of told me a lot, because when a market maker just says, screw it, I'm not doing this anymore, they step away, and then you get those crazy volatile markets to the point where it becomes circuit breaker. Them saying that, oh, this dark pool here, dark pool there, whatever. I could probably tell you where the dark pool is. Like, I can't show this because it's a paid service or something like that. But I can't exactly show you where this is. But let's see, where is it? 3234. Hang on. 4713. There was 16 million shares there. There was a couple at 50. 4534. Sorry, 35. 51 at for 1.9 mil, 52.37, 2.3 mil, and so forth. Honestly, if this was me, if I was still at an institution, I would have offloaded at those prices, because you bought in at $8 and you're making a 500% return. I don't think your clients would be dissatisfied by that. A lot of them, yes, might say, "Oh, well, why didn't you hold for the MOADs?" It's like, well, I saw profit there and I took it. These moves do not last very long. And sure enough, what happened? Like, let's go look. Oops. All right. So yeah. So it went up there. Went up to 60, 62. This does not look like a MOAS to me. Like, this is them. This looks like them just offloading, and you making 500% return when your normal like hit rate is sub 20% per year. Or sorry, no, not sub 20%, but like 12%, 8 to 12% a year on. Like, if we're using that as a benchmark. 500% return is quite excellent to take, and I don't think any manager would actually pass that up. So you obviously will regret, because I do it all the time. Will regret the missed profits, but profit's profit at this point. So okay, let's see what this person has to say. All right, let's go back through further back into the tweet history. Yeah, this person doesn't focus on it. I'm looking for someone that's so obsessed with it, like they look at it every single goddamn day, to the point where it just, like, you guys might not know this if you're new to trading. Like, there are guys who check the stock price like every couple minutes on their phone. Like, if they never used their phone before and they just like constantly checking what the price is. I've seen this before. Like, at my workplace, this kid was just looking at his Ethereum holding constantly, like every couple minutes, watching his Ethereum, watching his Ethereum, watching his Ethereum. It was like an addiction. For those kids who like look at social media constantly, like they have to keep being on Instagram. It was like that. It was that strong of an addiction. Mm-hmm. This person tweets too much. All right, hold on. I'm gonna ask Millennial. Millennial, is there a way to filter a person's tweet history to only show certain keywords? We'll wait to see what he says. How deep is this guy? That's a Robinhood bug. That doesn't say anything. Again, this is not. Oops. Day traders, retail, shorts will get smoked. The high frequency market makers manipulate the settlement times to dump buy at critical times to simulate sell-offs, and your YouTube analysis buying and holding truly takes advantage of settlement times. No, it doesn't. The settlement time has always been the same. It's always been basically by priority, whoever comes first, and that's pretty much it. High frequency traders don't get into a stock for very long. That's not the core of their thing. Their whole thing is to get in and out as fast as possible, make that half penny, quarter penny, whatever. Because again, this is not known by the regular retail market. There is a midpoint market that you can get into, and again, like not a lot of brokerages allow you to go hit the midpoint because again, okay. This is another advantage that the institutions have over the retail market because these are certain little nuances that the market, the regular retail market does not understand. For example, let's say I have an algorithm up at $50 on AMC, right? Let's be better with examples. Oof. Okay, so let's say it just does nothing in between here or whatever, right? It's like it's 38 cents by 39 cents constantly. It's just really whatever. The dollar amount doesn't matter. Sorry, the main dollar just let's ignore that for a second. Let's say it just keeps battling back between 38 cents and 39 cents right now. Well, let's say you start to get cold feet and you say, okay, well, I just want to get out of it, right? You put out your order. It's by priority, so whoever hits what first, and whoever is like. Again, if you guys know nothing about order routing, it's basically there's a bunch of different exchanges, or otherwise known as ECNs. You put your order out for there, and when someone says, "Hey, I want to get out this many shares at that price," they get routed to they basically hit anybody in that ECN book, but they can choose which one to hit. So you have Arca, you have Edge, you have Philex, you have BossX, you have Nasdaq, you have IZ. There's so many out there. Now, what happens is that if I'm routing it through, let's say, Arca, but you're sitting on Nasdaq, it will again, if you're the only one there and I market order this, I should theoretically be hitting you first because you're the only one there, you're the first one in line. That doesn't always happen. What happens is that someone will be there on Arca, someone will be there on BossX, someone will be there on EdgeX, and you're on Nasdaq or whatever. They can hit all the other market makers because again, these high frequency people might care, might not care about their fees, and they might hit them over you because you might be the more expensive one. Now, the interesting thing about that is that let's say they don't want to, they can't hit anybody there, right? They're trying to get somebody, but no one's taking the 39s or whatever, right? Well, it's 38 by 39. Well, why don't we just go 38 and 38.385? They'll be like, okay, all right, we're high frequency traders. We want to get out as fast as possible, and a half penny profit, getting in and out as fast as possible, is a lot better than having to get waiting to get the full penny profit or whatever, right? And again, this is a hidden market. You can call it dark pool, whatever you want, but like it's not actually a visual market. So you can throw your order out there. You can be queued up, same fashion as the lit market, but you won't. The likelihood that you'll know that someone's there is very, very slim and very, very nil. The same can be said about dark pool and everything. So this person talking about HFTs using this to manipulate settlement times and buy dump critical blah blah, that makes absolutely no fucking sense because for the most part, they settle pretty quickly, like for these things. And the typical settlement process takes about a day. They say like 2 to 3 days. It just depends on whether, in some cases, they can locate the shares or not, or if the person doesn't have enough capital to do so. But for the most part, trades are settled like typically at the end of the day. But this is also saying with the old style of technology where they have to write it down, and then the person at the end of the day that clears all the trades is settling. It's like, okay, well, you made a trade with this person, and you lost this amount. That means this person gained this amount, and so forth. They have to write that shit manually. But now today, it's done all electronically, so it just, that's how fast it settles. They just tell you, it's like, yeah, it's going to take 2 to 3 days to settle because they're trying to use that money in between for themselves, whatever, right? For whatever purpose they want to. And again, there's stuff that I might not even know of that goes on in between because so much has changed since I've worked in that type of industry. Again, I might be wrong, and you're more than welcome to let me know how wrong I am in the comments. But let's see how obsessive this person is. This person just retweets a lot. This is why I don't do options. Yes, there are some people that read options flow. I'm more of a equity flow kind of guy. The problem I have with options flow is that you don't know what their position is. Same could be said about stock, but this is them not putting any skin in the game, and that's something that I'm not really putting a lot of emphasis on. This guy only focuses on AMC right now. I'm sorry, hoping that they would bleed into other things, but so the reason why I don't focus a lot on options flow is because they just, yeah, again, you don't know, they're not putting any actual like serious money slash skin in the game, and that's not something I could say for equities. Oh, that's a large. One second, that is a large. What is this company? I'm not touching this. Oh, it's a foreign company. That's why it's probably a foreign exchange print. Okay. That's not a lot of shares, I'm just saying. 13 million is nothing. 300,000 shares at $40 for $13 million trade. That's nothing. Let's see what this guy has to say. Too much focus on this. All right, let's go see what StockTwits has to say. I never thought I would actually have trouble finding people for this type of indicator, but apparently I am. Some of my old candidates are great because one thought he was a god to trading because he was trading the SPY and doing options on it. But the thing with it is that I knew of the person. Okay, so basically what happened was obviously he was a fraud. He was trading 20 minutes delayed, and he would come on to StockTwits and like goad people and say, "Look, watch me make more money than your parents combined in a single day." Um, yeah. So it turns out he was a fraud. Big surprise there on my part, but I knew where he was scalping the information from, and he was basically copying the guy's exact playbook, which is he's selling a service for $100. I think it was like $100 a week or something like that to get his picks. But the catch to it was that he was 20 minutes. He was trading on a demo platform, which is 20 minutes delayed. But no one ever figured that out. But this guy was actually a good test subject because he made a bunch of different calls all the freaking time, and all you had to do is really, literally wait. Like he would call stuff like, for example, let's see, uh, ooh, this is a good one. TME. He called us at 10:20 to go long, and it has just been steadily declining. And the reason, the mentality for this was that China has been hit with nothing but negative news. It has to go up eventually. That is not. That's not solid. That's not solid due diligence. Like he came back and posted about this in late September. Sorry, not September, July. And he's saying, "Oh yeah, finally some good news about Chinese stocks or whatever." And then, sure enough, if that's what happens with good news. I hate to see what happens with really bad news, but their reasoning was that this is good news for the Chinese tech market. There's a lot of earnings beats in the U.S. and they expect China to be no different or whatever, right? U.S. tech is priced in, whereas like Chinese tech is undervalued. You know what else he said was undervalued? Baba. I don't know when he got into this thing, but let's even looking at it from the year point of view, from like the start of the year, you would have progressively gotten screwed on this thing quite significantly. Like you would have lost about 50% of your value right there. Or this person took leaps, but whatever. Those are two examples. One of the other ones was talking about. I had to find it, but this dude was talking about Bitcoin for like the longest time, and the problem with it was that. Oh, sorry, not Bitcoin, but he was talking about oil and gas, and it was like BMO exits oil. Yeah, there we go. So what he did was he posted this Bloomberg article saying, and this is an issue with a lot of people. BMO is getting rid of their U.S. oil and gas investment banking units, right? And he read it as, "Oh, this is great. This is why green energy is going to be the future and stuff like that." Let's actually read this article because he did not read this article. He just read this headline there. Why is this not reading? Well, it's capital market energy business where we focus on Canada. That's not them exiting the oil market. That's them basically saying that we're not going to invest in U.S. oil anymore. And that's where he stopped listening. What they actually fully said was, we're not going to, we're not going to invest in the U.S. energy oil market anymore. We're going to focus on the Canadian U.S. oil energy market. That's not them exiting the entire oil market. And this is the problem with like people like this, is that they read what they want to hear and they read what they want to see, and they just bounce. They run on that entire thing. It's so stupid.
BMO to exit oil and gas investment banking in the U.S. Bank of Montreal is winding down its U.S. oil and gas investment banking business and will focus on assets in Canada going forward, becoming the latest financial institution to cut ties with America's beleaguered shale industry. BMO said it has made the financial decision for an orderly wind-down of our non-Canadian investment and corporate banking energy business. Going forward, the company said by email, its capital markets energy business will be focused on Canada. The company is eliminating about 50 positions in its investment banking group as part of the exit that was announced to staff on Monday, according to a person with direct knowledge of the situation who asked not to be identified because the information isn't public. A handful of corporate bankers will manage BMO's U.S. oil and gas loan book, the person said. BMO is the latest bank to halt investment banking tied to U.S. oil and gas explorers, which even before the pandemic were facing pressure after years of generating meager returns. The move didn't appear to be related to ESG concerns plaguing fossil fuel companies. America's shale industry has been swept up in a wave of consolidation in recent months as the pandemic slashes oil demand, drags down prices and forces low-premium mergers. That follows years of lackadaisical M&A activity in the oil patch. Read more, bad energy loans double over 3 months, Canada banks say. On Tuesday, BMO reported gross impaired loans in its U.S. oil and gas portfolio of $457 million Canadian dollars at the end of its fiscal fourth quarter, compared with only $93 million Canadian dollars for the industry in Canada and other countries. BMO's U.S. oil and gas loan book was about $5.4 billion, 7 billion Canadian dollars, as of July 31st, making up half of its overall.
So, again, the person who posted this thing, he's posted a couple other things to review. He just went on this section here, exit oil and gas investments. That's it. But they didn't see the second part of this, which is going forward, the company said by email its capital energy markets business will be focused on Canada. His whole premise was that, oh yeah, well people are, it's great because screw the oil industry and stuff like that. The oil industry supplies a lot more than you guys think, and hang on. So EIA energy production by source. So fossil fuels, they account for 60% of your total energy production in the US, and with your renewables only fostering about just under 20%. Is this a claim that, oh, well, that's just because the US infrastructure isn't big enough to handle? No, it's not that. It's more so that you guys are more dependent on oil right now because it's a cheaper, more efficient source of energy than renewables. If I was to go down the list, well, wind, yeah, you can only put this in certain areas where it's actually windy. Plus, you can't really get a lot of energy out of this because, like we saw in Texas, when it froze over, a lot of their windmills stopped. So they kind of got screwed there. Hydropower, what are you going to do when, I don't know, let's say a drought happens? Or when the water levels in these dams, like Hoover Dam, is not producing as much power as it was before. Solar, you can only produce a lot of solar energy. Yes, there are peak times, but there is no way to store this energy, and a lot of this has a lot of other factors that are rolled into it, such as your solar cells get dirty. Well, your efficiency goes down. The sun is not directly beating down on the panels. Your efficiency goes down. The solar cells have a 20-year lifespan, and the cobalt in that is very poisonous for the environment, which is counterintuitive to your green energy thing. There's so many other issues with trying to get these renewables. Am I saying all renewables were bad? No, I'm not saying that. I'm saying that people are not realizing how dependent we are on these fossil fuels compared to these renewable energy techs. Yes, you can say, oh, well, the carbon emissions is making the polar ice caps melt. It's like, okay, cool. They've been saying that for like how many decades now? It's all such a shock and chill game right there. But again, you guys, the data's all here. You guys can go peruse that on your own time, but oh my. I wish you could filter this by bearish. Let's see who's very. No, this person doesn't post a lot about anything else. It's funny because if you were to look at this type of strategy from like a Peter Lynch more positive point of view, his whole thing is that he talks to people like normal everyday people who are not involved in the stock market because consumers make up 30% of the 30% of the U.S. GDP, and that's quite a huge chunk to ignore. Um, the problem with it that I have with it is that a majority of these people, when they get into stuff like this, they don't know what they're talking about. They will run as if they are an authority on the subject, which is fine. You know, you can claim that you're an authority on the subject, but I think it's kind of harmful because they honestly don't know. Like they're pulling a lot of these things out of their butts. Like the whole dark pool, the squeeze. It's like, okay, well, let's go look at the squeeze then. Oh, look, 28 million of that volume yesterday was short, and it has a 60% short squeeze. Okay, well, what's AMC's outstanding shares? Okay, so the outstanding shares is about 51, half a billion. The current float is about half a billion. So let's take 28 million divided by half a billion. 5.4% of your entire shares is short squeeze, which is counterintuitive of what Course said, which was and this is 20%. He's saying that 114 million versus this daily number, which again, he's getting this from Ortex, which is getting it supposedly from S3. But the problem with that that I have right now is that obviously, if you look at the source, the problem with it is that they can only get it from the brokerages or agents who are willing to report to you. And there's a lot of them. A lot of them might not even want to report to you, and that's just the reality of the situation. Because they don't want to report to you, they're not obligated to report to you. They're only obligated to report to the actual regulators like FINRA, NASDAQ, NYSE, all those people. They have to report real numbers to them. This one is pulling from FINRA, their reg show, which is actually an official source. You can go search up FINRA reg show daily short. Let's see here. Yeah, so you can go here. You can download this little text file, search up AMC, and it is around, I can't remember which column it was. Where is it? So this will give you the short volume, short exempt volume, total volume, and market. So they're pulling from this data set here. They're pulling from this data set here. And honestly, none of these say like the 100 million that Coors is quoting. So I don't know where they're getting this figure, but I'm not saying they're making it up. I'm just saying that it just doesn't match up with an actual regulator that they have to report to. Could be more, could be less, but like I'm leading on the case that it's actually drastically less. But oh my god, where is if you guys don't know who this is Muddy Waters / Carson Block. There's an excellent Netflix documentary on there called The China Hustle. Carson Block is one of the famous short sellers, and I know a lot of people hate short sellers, but this guy knows his stuff. Okay, let's see. Where are we on the day? Interesting. So this was, let's see, 1.7 million. How many shares does this trade on average? The entire day's volume done in just like that. Interesting. One, 15, 30, 40. Okay, so you guys don't know what I'm doing. I am essentially, again, looking at this from a super long-term perspective, but oops, no, that's not it. From a super long-term perspective, and this is going into Bury. I don't care where you stand in the situation. I like Bury, and this is my stream. I can do whatever the hell I want. So the thing with it is that this is the scenario we see right now. So no one's giving a crap about Evergrande right now because it's like that's a in China issue. It's not a North America issue, right? And that's fine. You know, you guys should mind your own backyard before you care about someone else's, right? So here's the problem I see with it. Everybody's flying there to invest in China. So we saw this happen with Greece, with the Eurozone, with the UK, and everybody. Like, the US doesn't just invest in itself. Everybody's connected in one way or the other because their governments issue bonds. People don't just buy US bonds, and the US doesn't just buy US bonds. The US buys foreign bonds and buys other foreign currencies. Same with Japan. Japan has US bonds and US currency. That's how they survived through the Asian financial crisis. Now, when the Eurozone happened, the Euro crisis happened, the US was very deeply invested in the Euro. And you could literally see this. What happened in Europe the night before happens in the S&P the following day. It was weird. Like the EU market would dictate the direction the night before in the US, and I was using that in my early days when I was starting. I didn't know what I was looking at, but that's why I noticed. And the reason for that was because the US was so deeply invested in it. Sure enough, what else happened? Well, then Cyprus happened, and Cyprus took down like a lot of the Greek crisis happened. Cyprus took down a lot of North American companies. It was a very big slaughterhouse for the U.S., but that's just that. And the problem I see right now is that they're doing the same thing over again, which is basically they're investing a lot in China. One great example of that is look at the NBA. They are having a huge push to try to break into the Chinese market. Look at Disney. Shang-Chi was aimed at the Chinese market. They're all trying to get the Chinese dollars. Again, that's fine. Like that's just there is money to be made there. I'm not denying that. However, when you tie yourself into that, you also expose yourself to that country's risk. Like for me, because I'm investing in the US, if something happens in the US, that will affect me because like we're so closely tied. We are like essentially like Canada and the U.S. are basically neighbors. We are we're big trading partners next to each other because we have land borders. It's a lot easier than having to ship a cargo container back and forth, right? But again, they don't buy a lot from us. They buy mostly from China. So think about it. Just everything you buy from, like everything you buy is made in China. And to have them go down or have them have a disruption, it will affect you. Stuff will cost more, stuff will be not cheaply as made, so forth, whatever. You guys can come to your conclusions of that. So, one weird thing about this is that, yes, if China goes down, I think it's going to take the US with it, or it's trying to take the US with it at this point. How does this, why does my trade become important? Well, one thing, it's a lot to explain. Rita does this way better. If you guys don't know who she is, there's a link down below to her stream. She could probably ask her on Monday when she started to stream. But for the most part, I think what's going to happen is that the U.S. wants to raise interest rates because they have to. Their bonds, no one's buying their bonds, and they want people to buy their bonds because that just counts as inflows towards them, right? It gives them money to do stuff, which in turn they can use that money to go invest in other people. It's just a weird little circle jerk. But in order for them to attract more investors and to have that confidence, they have to raise interest rates. And the way they do that is they short these long-term ones, so the 20-year plus, and they long the short terms, which is like the one that I was looking at earlier, the short terms, like IEF, like the 7 to 10 years, like anything under 10 years or whatever, like the shorter the better. And that's basically how they manipulate the interest rates. That's how the Federal Reserve does it. But for the most part, that's kind of what I'm banking on right now. But there are scenarios where like these both will go down because their bonds aren't simply aren't worth it on both ends. At least in my opinion. Like I don't know too much about bonds. Like I'm not the expert in bonds. I always deny trying to learn it because it's just too five-head for me. I don't have the brain capacity to learn it. If you want to learn about bonds, I'm not the person to ask. But if you are going to learn bonds, you will be so ahead of the curve that people think that A, you're crazy, but B, when it happens, you'll be that one person smirking in the corner and be like, "I told you so." Again, you guys do whatever you want with that situation, but these guys think so far ahead that they have to move on these things, and they are the smart money in the room. Let's see. Sorry, I'm just checking my portfolio right now. Damn, I missed that good entry price. All right, well, whatever. Okay. Let's go look at some of the other ones. Ooh, this one's a good one. Who's bullish on this one? This guy's too focused on this one. I want him to. I want to find people that are just. They're so diversified. They think they can everything they touch turns to gold. Again, I never thought I would have issues trying to find someone like this, but hello. This guy looks like a candidate. Okay, let's start looking at some of his books. So, Ride Workhorse. He's been screaming this constantly since. And again, you guys can do whatever you want with this thing. Like, this is just something that I personally observed. If you feel that, actually going with these people is a better bet, that's your prerogative. You can play it however you want. Like, I'm not here to tell you how to trade or what to trade. You can, you make your own decisions, and you therefore reap the benefits or the consequences of either. So, late June. Okay, late June. This guy's been diehard in it ever since, down 30%. Late June, down 50%. Damn. Let's see, is he consistent with this thing? No stance on that one. He does talk about other things, which is something I want to see. Hang on. This might be a low float, which I don't have. I personally even wouldn't want to touch, but what's this thing? Yeah, I'm not touching that shit. Okay, let's look at ecos. I think that's an ecological. I think it's like they make like cleaners or something like that. What is this? Yeah, it's OTC. I'm not gonna touch that either. This guy is a candidate though. Touches a lot of OTCs. That's the only issue I have with it. I want him to get into a lot more reputable exchanges. Let's go back. Man, he's really attached to Ecos. I'm just gonna look at this for shits and giggles. So I'm not getting into this thing, but so since the beginning of the year, April, 27% ish, but let's see. Oh yeah, no, he got in during the when the virus. Everybody was like freaking out and stuff. Yeah, before that. So he started this year, but I like this, so I am going to add him to my list for now. I want to see how he develops. I want to see what I'm looking for is I'm looking for him to get progressively worse and expand into other stocks. Ooh, this guy looks good. Ater, yeah. Looks like we got a live one. Well, I just gotta check out. I gotta catch up on what they wrote. Spending rose 0.8%. Okay, back to this guy. All right. So, Ater. This was actually something of interest to me before, but 22. from the 22nd when he talked about this thing is down about 34%. I like what I'm seeing so far. NNBC. This looks like, yeah, it's a bio play. It's kind of risky. I personally wouldn't play this one because it's bio, and I have a personal dislike for bio, but yeah, this person lost another 20%. Ater 17th. I can play this. 17th to, so that's about 50%. Not bad, I guess. Let's see. Oh, this dude kept adding. All right, I'm gonna go down as far as I can because I think he's. Oh wow. Okay, yeah, he doesn't post a lot. Okay, so it's CTRM. Oh yeah, I remember this stock. This company, I believe, I remember Millennial telling me about this company. They kept buying new. They kept buying new ocean liners, or not ocean liners, ocean freights. And this was at a time when people were kind of going broke and stuff. So the fact that they were just buying more and more to handle the global shipping needs is just, that was interesting. I guess that's what caused the run there. But let's see, so February, buy until 7, probably be back to 1 2. So he held this till March. So he got in February, so late Feb, sorry, mid Feb, and then he held it all the way through. Dicey. Okay. Oh yeah, I like this guy. He's arrogant. As it kept going down, and then into March. So that's the third month. So we're here. Yeah. So this is when, so 3-8. So there, that's when he started getting arrogant, when it started to recover. And then later into March, it started to die. Let's see how he reacted. Did he jump off into something else? Oh, he started getting confused, frustrated. He added more on in April 5th. Okay. And it did nothing but progressively die. Okay. And he stopped talking about it. Okay. Yeah, this guy's a winner. I like this. I'm definitely gonna add him to the list. Again, if this seems cruel, I'm not forcing these people to trade. I'm literally watching their behavior. That's all I'm doing. Like behavioral finance, like Rita says, is a recent concept, but it's so strange how it's a recent concept because people have been emotionally trading for years. And that dude, I don't know what happened with this thing because he said he put in 20,000 for that thing, but he had 20,000 shares of CTRM, but not a lot of talk about that afterwards. So this guy's also talking about something else on a different board. Nah, he's too ride or die. It's gonna be far back. He meets the obsession marker. Nah, he's... It looks like he's just too focused on ride and workhorse, and he just keeps like going to other boards to talk about it. Yeah, like there. Oops. No, that's about workhorse and ride again. Workhorse and ride. Workhorse and ride. Oh, he'd be perfect, but he focuses too much on workhorse and ride. Yeah, I'm gonna chop this up to a no. People that post that frequently about like every little bit of information don't move the market. It's not critical. Hold on, wait, was he bullish on SOS? No, he had no comment on that. Or sorry, he had no direction on that. Alright. Let's see what he has to say. I mean, he has the right call for some things, but like he's very focused on ride. I see other tickers from time to time he mentions, but I think that's just him dumping on them. And that's not something I. Whoops. I want him to. Oh wow. Okay, yeah. So he was actually long on that thing. I stand corrected. Post frequently. Save. Okay. Okay. I almost crossed him off, but I think he's actually a good candidate for this. AL would be green by opening bell. Okay. $7.23. So July 23rd. Slightly negative, but not too negative. SOS is, I mean, SOS, the fact that he's getting into SOS alone and obsessive about it makes me want to put on the list, but let's see, Zella in July. $23. Short term. Okay, back on AL. Just keeps getting progressively negative, but sure. Yeah, I'll give him a shot. All right. So I got 2 people I got to study on, but yeah, there's my hour stream. Like I said earlier, like, comment, subscribe. Hit the subscribe button, subscribe start down below. I want to hire an editor that I have in mind. The money's just basically to go to him as graphics and so forth and stuff like that. But let's see, what else do I have to say? Stop listening to stupid people. Do your own research. Don't get swept up by the hype. Yeah, I mean, there's a lot to say, especially with what's going on in the market, and just I would just say be careful out there right now. Stop listening to these like guys who you guys see as authority figures, like I'm not gonna say his name anymore, but stop looking at these guys as authority figures, like Ray Dalio, for example. The guy blew up 3 funds, and he says that he's better. He's basically acting like he's so great, and people keep putting him on a pedestal, but all he does is just buy more Berkshire shares. It's the epitome of that TLC song, which I know Rita hates, but the TLC song Scrubs, and that's Dalio. Oh, thanks, Stunks, Stunks Soros. Yeah, thanks. I don't know if it's gonna happen or not, but like we are getting really close to it. Like from what I'm seeing, I think what's gonna happen is that, like I said earlier, I think that because people like BlackRock said that they were going to get more exposure to the Chinese market because it's a steal right now. But if it's going down, it's going to go down. It's going to bring them with us. It's going to bring the U.S. market with them, right? So again, like it's not going to be one for one all the time. The names change from time to time. Sometimes the tactics change, but the end results always end up the same, right? So again, uh, do some more research on top of my research. Obviously, like confirm what I say all the time. Um, but like honestly, if this is my personal opinion, I think that if they didn't actually get more exposure to the Asian markets and they just invested in their own country and just to stay strong and stable, I think they'd be fine. But they're not doing that. They're like, well, China's a steal right now, and they're dogpiling in there. It's like, oh well, yeah. There's a lot of geopolitical risk there, so we'll see. I could be wrong, but I don't advocate anybody put too much money into anything because you might need that money to survive, and having that cash on hand is a lot more useful than having to hold on to a stock at its all-time highs, waiting for it to come back eventually. But I don't know. We'll see. But yeah, I'm gonna head out now. But thanks for showing up, dude. I really appreciate it. I'm just starting the stream thing, and if you didn't catch the early part of it, I broke my hard drive, kind of, or it's on the way out. I might not have a Sunday video, so I might just go live. So you'll see, like that on noon Sunday. But yeah, thanks for showing up. Those who did, those who liked, comments, subscribed, and everything. I'll catch you guys later.